Let's go to a very interesting author with a very interesting book, Michael Hudson. He has written for the New York Times, Los Angeles Times, Mother Jones. He's won the George Polk Award, and he was a longtime writer for the Wall Street Journal, as a reporter, of course. And his new book is The Monster: How a Gang of Predatory Lenders and Wall Street Bankers Fleeced America and Spawned a Global Crisis. Michael, welcome to the Young Turks.
Great, thanks for having me.
Great to have you here. So, now, if you listen to different people, they've got all sorts of different ideas on how this meltdown happened in 07, 08, et cetera, right? For example, Republicans will tell you, oh, it was all the government. It was all Fannie Mae and Freddie Mac. And what they did is they made poor bankers give loans to these people who shouldn't have gotten the loans, and hence it was Barney Frank's fault. Okay.
Right. It's interesting. I just did a sort of a radio tour on Thursday where I was on about 20 stations around the country, and I think at least 3 of them basically wanted me to talk about how Barney Frank had caused all this, and were a bit upset when I tried to explain, well, there were some other factors involved.
Okay. Now, look, I think Fannie Mae and Freddie Mac are a disaster, and so they were a contributing factor. So we don't have to get into that. I didn't bring that up to make sure that we go into that whole detail. But I brought that up in the context of what I want to know is what's really at the heart of this problem. What really caused this collapse? What was the institutional factors and who was involved? So, and I know your book's about that. So let us know about that a little bit.
Right. Basically, what happened was that we had 2 corporate cultures get together. We had Wall Street, and we had the sort of cowboy capitalism of Orange County, California, where almost all the major subprime lenders grew up and flourished. When those 2 got together, when the Wall Street money started flowing to the subprime lenders, that's when subprime went from this sort of small, marginal market into this monster that was capable of hurting millions of people, and then eventually, crashing our economy and spawning a global meltdown.
All right, so let's understand the incentives and how it works. So, for example, even at this late juncture, some people might not know what a subprime mortgage is. What is it, and how did it grow?
Well, supposedly a subprime mortgage was a loan with a higher interest, higher fees to someone who had bad credit, weak credit, or maybe just low modest income. Actually, what it ultimately ended up being was a subprime mortgage went to anyone who was willing to take a subprime mortgage, and because the salespeople were so aggressive and so good at what they did, often a lot of people who didn't qualify for subprime loans, they actually qualified for a regular loan, ended up getting stuck in these really terrible subprime loans that were often structured like time bombs. They would look good at the beginning, there would be a low initial payment, but then eventually they would explode and people would be in big trouble.
So what happens is after X period of time, 18 months, whatever it might be, all of a sudden their interest rate goes from, and I'm making up here numbers here as an example, goes from a reasonable 5% that they could pay off, that they had the capacity to pay off, to 10% or 15%.
Right, or let's say 7.5% to 9.5%, and then another 6 months later, 11.5%, on all the way up, possibly as high as 14 or 15%. What would happen is folks would get these loans. They would get a loan, and they would struggle by. Even once it adjusted, they might take money out of the 401k. They might borrow money from relatives, whatever, and they would hang on for a year or 2. But eventually, the only way out would be able to get another loan. And of course, you're either a different subprime lender or your original lender would be more than happy to give you another loan because they would load up on more fees. Because housing values were going up, they knew you had a lot of equity in their house, so they'd load up on more fees. And often you would have people who would have 5 loans in a period of 5 or 6 years. Not because they were necessarily using their houses like ATM machines, but just because they were desperately trying to outrun that first loan and then, pay off the previous loan by another one, and sort of stave off the inevitable. Eventually, let's say on the 5th loan, they would collapse under the weight of the fees, and it would go down on the books. Remember, on the subprime lenders' books, it would go down as if there were one bad loan, the last loan where the borrower finally defaulted and went into foreclosure on, and then 4 quote-unquote good loans because, those first 4 loans had been paid off. But the reality was that all 5 of those loans were bad, unpayable, doomed to fail loans, just predatory.
So now I get the reason why the guy who's buying the house did it initially. He gets in the beginning a nice interest rate. Maybe he doesn't see the ballooning interest rates. Maybe he's optimistic and thinks he can pay those interest rates later. And he gets into a house maybe that he couldn't quite afford, but it likes that he's in it, right? So those are among the issues why he'd want to get involved. Now, why does the guy who's doing the subprime loan, because a lot of people would think, Michael, well, at some point that loan's going to explode. Everybody knows that, right? And they had to know that. So at that point, they would think, hey, you know what? You've got this default, and it's going to cost you more in the long run, so it might not be a savvy business move. But that's not how it was structured, was it?
Right, because the small lender who made the loan would then pass the loan on to a bigger lender who would then pass the loan on to a Wall Street bank, which would then offload it into something called a special investment vehicle and pool a bunch of these loans together and then sell basically shares in the loans or bonds based on the income stream from these loans to investors all around the world. So the pain was, there was a lot of insulation between what happened at the lower level and who actually owned the loan. And because of the fact that most of the people on Wall Street knew that these loans were being refinanced over and over again, they knew that you know, it was sort of like a game of musical chairs. You probably weren't going to be the one who got caught when the borrower went into default because the loans kept being refinanced over and over again.
So two quick things on that. We're talking to Michael Hudson. He wrote the book The Monster, explaining how this all grew out of control. So if you're the guy, the original guy making the subprime mortgage and giving it to somebody who's going to move into a house, since you're going to pass that mortgage on to someone else, you don't care. You have zero incentive to make sure that it's a loan that gets paid back, almost, right? I mean,
almost no incentive.
Right, but you have a tremendous incentive to make more of them because you'll get fees for every single one you do. Is that right?
Right, and the worse the loan, the higher the interest rate, the more risky the loan was, the more money you get. If you're making plain vanilla mortgages, you don't get paid much. But if you're making the subprime loans, if you're making the option ARMs or the Alt-A mortgages and all this other sort of alphabet soup of loans, you're going to make lots of money.
So I think that's what a lot of people don't get. You know, for example, in Countrywide, they nearly double their profits by making riskier loans. Instead of getting a 2% return, all of a sudden they'd get a 4% return because it was riskier. But they carried none of the risk.
Right. The difference, the interest, you know, the interest or the profit margin on a plain vanilla loan on a subprime loan was 4 times the profit margin on a regular loan. So all the incentives were all there.
So all of a sudden you have all these guys who are giving out mortgages that have tremendous financial incentive to make the mortgages worse and worse, to make them riskier and with exploding balloons, et cetera, et cetera. Now, what's feeding that is the people who are buying those mortgages from them, the banks above them. Now, right. Why would they buy those crappy loans?
Because they know they can offload them to somebody else. They can offload them.
Tell us how that works.
Well, you pool the loans, and then you sell bonds backed by the income stream from the loans. The investors buy those. They're the ones who ultimately own the loan. And the idea is, well, there are thousands of investors all over the world who are buying a piece of these pools, so everyone owns a little piece, and no one has total vulnerability on this. So you knew, and the other thing was, this is very Ponzi-like. As long as you could keep doubling and tripling your volume every year, and remember, you know how we talked about it might take a couple of years, you know, at the least before someone who got a bad loan would sort of get in trouble and fall into default and have to refinance or go into foreclosure. So if you could double and triple your volume every year, your defaults from the loans, say, that you made in 2003, by 2006, they would start popping up, you know, with a vengeance. But if your volume is 4 times what you were doing, you know, overall, what you were doing in 2003, those defaults are a much smaller percentage of a much enlarged whole now. So as long as the key, this is all about growth, as long as you keep growing. AmeriQuest, the largest subprime lender in the early 2000s, was doing about $6 billion in subprime loans a year. By 2004, they were doing $82 billion a year.
Jesus. Okay, that's a stunning number, right?
Right.
We're talking to Michael Hudson here. He used to work as a reporter for the Wall Street Journal. He's now a writer for the Center for Public Integrity, and he wrote the book Monster about how all this grew out of control. So, Michael, it goes from America Quest making these subprime loans up the ladder, and it involves so many different banks, right? And that's why we had a systemic problem when everything crashed. But who's the ultimate sucker? Who finally gets left with the hot potato?
Well, we are all the taxpayers who got stuck bailing out banks, all the pension, all the people who have pension funds that public pension funds that have taken hits. Everyone, the people who are suffering them, and the homeowners who got the loan. So it's the profits were very limited to a few people. Few thousand people maybe in the mortgage industry and on Wall Street, but the pain and the risk have now descended on millions of people.
So, for example, if Bank of America gets stuck with a lot of these loans, which they did, right? They say, well, partly sad day for our shareholders, and a lot of our shareholders are pension funds, for example.
Sure.
But the executives of Bank of America made out like bandits. They made a tremendous amount of money as all this unfolded because they were getting paid on the profits that they made in the short term, right?
Right. And an example, Countrywide, which was eventually bought by Bank of America, as it started to fall, its CEO, Angelo Mazzillo, according to the federal government in its recent lawsuit, took $140 million in what the government said was ill-gotten gains, improperly taken out through insider trading and securities fraud. When he settled the case, the settlement was for less than half of that, $67 million, but Bank of America and Countrywide's insurance companies paid most of that. Angelo Mazzillo paid about $22 million, which by my math means that he paid about 16 cents for every dollar in ill-gotten gains, according to the government.
By the way, and I want to be clear on that because I'm obsessed with that case, that was the ill-gotten gains in just the last year when he was sucking the money out of the company, selling his shares.
Or maybe last 2. Yeah, it was at the end. I don't know if it was just the last year, or maybe the last year or two, because he changed his stock plan basically because as a CEO, you're supposed to have an automatic stock selling plan so you can cash in some of your stock, but you're not supposed to just go cash in your stock because it would allow you to do insider trading and cash in on knowledge that your company is about to go under or that the market is about to crash. But it was alleged that he sort of manipulated that, and that was part of the government's allegation.
Right, and I want everybody to be clear on this because to give you a sense of who got rich and who got robbed, right? So Mazzillo in the last year and a half got about $140 million, as the government says. In the last 3 years, got $260 million. Over the time that he was the CEO of Countrywide, he got approximately $600 million, and then comically paid back $22 million of it. Okay,
right.
So he had all the incentive in the world to do this.
Yeah, can I give you another example that's even the numbers are even bigger? Roland Arnall, who was really in many ways the godfather of subprime. He helped create the modern subprime model out of Orange County in the late 80s. He built this empire eventually that became AmeriQuest, the largest subprime lender. He was rich enough and powerful enough where he was George Bush's biggest source of political cash during the 2004 election cycle. Eventually was appointed as Bush's ambassador to the Netherlands. Arnall, in a 3-year period, a 3-year period kind of in the middle of the boom, he took out personally $2.7 billion in profits from his subprime empire. Now, eventually, a coalition of state attorneys general and banking agencies forced him to shell out a national predatory lending settlement, his company, to the tune of $325 million, which sounds like a lot, but if you do the math on that, it's a pretty small fraction of the $2.7 billion he made in a 3-year period, and it's actually less than his companies were spending on advertising and marketing at the time. They were had got the naming rights to the Texas Rangers field. It was AmeriQuest Field. They sponsored the 2005 Super Bowl halftime extravaganza with Paul McCartney. They were sort of everywhere in the sporting world.
So, Michael, now let's finally get to the consequences of this. So, first of all, by the way, as we're talking about all this, and Arnold had all the incentive in the world to make the $2.7 billion. You know, you got $600 million for Mozilla. Joseph Cassano, who was the head of AIG's financial products division, he made another $600 million. I'm missing the part where Barney Frank made them make all this money.
Well, you know, it's this idea that you know, we go back to Fannie and Freddie. You know, part of it's easy, right? I think, you know, there's Barney Frank, this guy was a Massachusetts, you know, was it a would you say a Massachusetts brogue or whatever, you know? Mm-hmm. And you know, and so there are certain people who don't like him or think he's, you know, whatever. And so it's easy to say it's Barney, you know, that's an easy name to remember. And then it's Fannie and Freddie. You know, it's like a children's show or something.
Yeah, you know, Michael, I'm a lot less generous than you are. It's Republicans who want to protect people like Mazzillo and Arnold, because Arnold literally is their top donor, okay? They want to protect those guys, so they try to trick you and divert your attention by going, oh, it's that Democrat Barney Frank from Massachusetts who did it.
And as we said up front, there's no doubt that Fannie and Freddie played a role in this, but they, you know, everybody, you know, there was a Republican committee staff report that said, you know, if you have to understand how Fannie and Freddie caused this, and then how Lehman Brothers, you know, followed the lead of Fannie and Freddie, and that's how we got this meltdown. And actually, the truth was just the opposite. Lehman Brothers and other Wall Street, you know, firms were in on this back in the late 90s. Lehman Brothers, over an 11-year period, 10 of those 11 years, they were either number one or number two for the volume of subprime mortgages that they rolled into these securities deals. Fannie and Freddie actually lost market share during much of the mortgage boom from 2007 to 2000. I'm sorry, from 2003 to 2006, they went from 70% to 30% of the market. And what happened is in an effort, and because of pressure from people like Mazzillo and others, in an effort to catch up and maintain their market share and not get beaten up more, they did start doing a lot more of these risky loans. And because of their market size and their market volume, they really exacerbated the size of the meltdown and the intensity of the pain.
Michael, let me understand that just a little bit better, right? Didn't Fannie and Freddie and their executives have almost the same incentive, in fact, in some ways worse, than the privately held companies or the public corporations like Bank of America? Well, because their executives were going to make the money just as the executives of the other companies were going to, and if they had a problem and they defaulted, it's their shareholders or the taxpayers that are on the hook, so what do they care?
Right. Well, and of course, part of it was they did. I mean, Fannie and Freddie were basically were operating as private companies. They had shareholders. They had profit expectations to meet, and so they weren't that different, except for a little bit closer relationship to the government than, say, Bank of America and Citigroup. But as we saw at the end, it wasn't just Fannie and Freddie that got bailed out. All the private banking institutions got bailed out in the end. But the other thing that keeps getting brought up is the Community Reinvestment Act, which is a law that was passed many years, decades ago, which basically says banks need to serve all communities and need to make loans in low-income and minority neighborhoods because there was lots of redlining and lots of discrimination. Almost all of the subprime lenders, including Ameriquest and New Century and most of the biggest ones, were not covered by the Community Reinvestment Act. They didn't make these loans in minority neighborhoods because the government forced them. They made these loans because they were wildly profitable.
All right, so those are the lies. Now, when we get to the truth about how to fix this, unfortunately, the answers aren't any better, right? Because we know how to fix it, right? I mean, you can give us a couple of prescriptions on what we would do. Unfortunately, we haven't done any of it, have we?
We've done some of it, but not all of it. I mean, much of it is left to be written because the Consumer Financial Protection Bureau, which is set up as part of the financial reform, it has wide latitude to write rules about dangerous credit products. Just as if you're a manufacturer, and I think Elizabeth Warren always uses this metaphor, and you make in 1 out of 5 of your toasters catch fire. If you're a lender and 1 out of 5 of your mortgages go bad in a short time, then the question should be raised and there should be, quote unquote, a recall. But really, what's going to happen with that has yet to be written, and there's going to be as much lobbying, and it's going to be just as vociferous as it was during the legislation by the financial industry to attack those rules and try and weaken and undermine what's going on.
All right, Michael, so let me run two things by you real quick. First of all, if you had to keep the loan that you wrote, wouldn't that give you an enormous incentive to make sure you wrote a good loan rather than a bad loan? Wouldn't that be a huge step in the right direction?
Right. I mean, it's the old Bailey building and loan model. That would be a good step. Or have what they call assignee liability. If you do sell the loan, whoever buys the loan has responsibility if, in fact, the loan was made by one of these mortgage brokers or small lenders, if there was fraud or other problems in the making of the loan. So the bad things that are happening on the ground level at the point of sale would need to follow the loan as it's being passed through various owners.
Now, did we do any of that?
No, they tried to do that in the state of Georgia. Roy Barnes, when he was governor in 2002, pushed through the toughest predatory lending law in the country. And after he got voted out of office for other reasons, in early 2003, there was a Republican governor, and Wall Street, the mortgage industry, S&P, and the other rating agencies, and the federal banking regulators basically descended on Georgia and said, we're going to shut down your mortgage industry if you do not change the law. So they changed the law. They took out the assignee liability and some of the or weakened it to a point where it was meaningless, and some of the other key features of the law. And as a result, the message was sent around the country that you don't mess with the mortgage industry, you don't mess with Wall Street, and also Georgia has one of the highest foreclosure rates in the country.
So shocking! It turns out the deregulation helped the robbers and did not help the American people. I didn't see that coming. Now, look, I was going to go on to a second point, but there's 100 points. We could ban the derivatives on this stuff, but we didn't do that. There's 1.5 million things we could do as regulation that we didn't do, as Obama pretends we have the best, the most historic financial reform ever. And the bankers pretend they got hurt. Last question for you, Michael. Doesn't that show you that if you're going to rob people, you should rob them on a really large scale?
That seems to be the case. In the almost all the people keep asking me, has anybody gone to jail for this? And in terms of the mortgage debacle, as far as I know, almost all of the folks who have been prosecuted, have gone to jail, are low-level people, mortgage brokers and people like that. There have been no, as far as I know, any high-level executives who have been criminally attacked on this issue.
Right. And by the way, once you take all that money and you give a tiny percentage back to the government in a fine, make sure you buy politicians with some of that money. And you don't need much of it. Politicians are cheap. So that's the state of American politics, unfortunately. And the state of how we got in this mess is explained very well in the book, The Monster, How a Gang of Predatory Lenders and Wall Street Bankers Fleeced America and Spawned a Global Crisis. Michael Hudson's the author. Thank you for joining us, Michael. Really appreciate it.
Thanks so much.
All right, we'll be right back.
Years of